by the end of 26. I called my editor the other day and I said, we have to publish quickly because I'm going to hit that before we publish the forecast. But
I was going to say, are you going to move that forecast now?
well, I probably will. I mean, candidly, it would not surprise me, not even a little bit, to see $10,000 gold before the end of 2026. I think we will. I like to be conservative in my written forecast because it's good to be right. But $5,000 is within reach. But $10,000 would just come as no surprise for gold.
It's been suppressed for so long. We've had a shortage of supply for the last 6 years or so. Meanwhile, industrial demand has continued to grow and grow and grow. I mean, the shortfall over the last 6 years works out at just a little less than one. I think it's sort of, I can't remember the figure.
The Fed is practically irrelevant in a lot of ways, not just the price of gold, but in terms of monetary policy and so forth. We don't have time to do a deep dive on the Fed, maybe some future show. But I would, you're right. That's just some Bloomberg writer trying to get through the day. The Fed has nothing to do with it. There are drivers of gold. There are fundamental drivers. Now, some of this is momentum. It gets going and people jump in, but we're not at the crazy, momentum stage where, it's a retail outlet. People were lined up around the block. I mean, some places, but we're not there yet. But there are some really deep fundamental things driving gold. One of them we've talked about before. Central banks are net buyers. That tipping point transition that was in 2010. From 1970 to 2010, central banks were net sellers. Since then, they've been net buyers, but the number of central banks joining in and the amount of net buying is continued to increase. So that's just a good fundamental driver. And it's important for investors because central banks are actually pretty smart buyers. They mess up other things, but they're pretty good when it comes to buying gold. They don't chase the price, but they kind of put a floor under it. No guarantees, but they buy the dips, to use a cliche. Russia's a good example. They're very transparent. They would just put in a standing order, 10 tons a month or whatever. They didn't want to disrupt the market, but if they see a dip, they'll buy it. So you've got it's great for investors because you have all the upside. But the downside is kind of limited because the central banks will step in. So that's number one. Number two, good old-fashioned supply and demand. The supply has been flat for 7 years, around 4,000 metric tons a year. Up a little bit, down a little bit. I'm not saying peak gold or gold output. There are no more gold mines that are out there, although they are getting harder to find and more expensive to mine. But demand keeps going up. So at least where I went to school, when demand goes up and supply is flat, the price goes up. That's how you make the market work.
One of the most powerful forces in gold today is central bank behavior. After 4 decades of selling bullion, central banks crossed a historic threshold around 2010 and became consistent net buyers. Since then, both the number of buyers and the size of purchases have steadily increased. These institutions do not chase price spikes. Instead, they accumulate quietly, often during pullbacks, effectively creating a price floor. Nations like Russia demonstrated this discipline years ago with steady, transparent purchases. For investors, this matters deeply. Central banks may misjudge many policies, but when it comes to gold, they think long-term, and they rarely panic.
Institutional investors are dipping their toe in the water. And the thing to understand about institutional investors, now I'm talking about sovereign wealth funds, endowments, big mutual funds and so forth. Their allocation to gold is tiny. It's like 1 or 2%. You would think maybe it's 5 to 10%. It's not. 1 to 2% is the right order of magnitude. If they just went from, let's say, 2% to 3%, that's not like a huge move. But just going from 2% to 3%, the amount of dollars involved was so large that, there's not enough gold in the world at these prices. That's something that would shoot the price even higher. That's starting to happen. So, and then the fourth element I would list is, we still have bombs and missiles, but a lot of 21st century warfare is financial warfare. And this a lot started with the effort of really the EU, but the U.S. was involved at the early stage to steal $300 billion of treasury securities from Russia that Russia bought them legally, made the money on oil, bought them legally, put them in a custodian in Brussels called Euroclear. But when the war broke out in 2022, those were frozen. That's to be expected. But Europe took steps to steal them and use them as collateral for a loan to Ukraine. So Russia would be financing Ukraine in a war where they're fighting Ukraine. It was a crazy idea. It seems to have died down, but it was out there discussed for years. Well, if you're Saudi Arabia or Japan or Taiwan or Brazil or any large holder of U.S. Treasury securities, you're looking at that and saying, hey, what if the U.S. doesn't like something I do? What if I'm on the blacklist someday? Maybe I ought to diversify into gold, and they're doing that. So you have, again, I'm not saying they're dumping treasuries. That narrative is not true. But as new reserves come in, they are buying more gold. So these are really fundamental things that are pushing the price up, and are going to keep it there.
Gold supply has barely changed in nearly a decade. Annual mine production has hovered around 4,000 metric tons, while new discoveries become rarer, deeper, and more expensive to extract. Meanwhile, demand continues to rise. Institutional investors, sovereign wealth funds, pensions, endowments remain dramatically underallocated. Gold typically represents just 1 to 2% of their portfolios. A move from 2% to 3% may sound minor, but at institutional scale, it would overwhelm available supply at current prices. This gradual reallocation has already begun, and it does not require panic buying to push prices significantly higher.
China actually does like silver. They've been buying enormous amounts of gold. We've talked about that. But historically, China has always treated silver as a precious metal. In fact, until fairly recently, they settled their balance of trade in silver. That's and they like that. So they're part of it. But there's a lot else going on. We don't know all the facts. But there have been some supply disruptions in the London market. And the lady named Blythe Masters, she was the head of commodities trading for J.P. Morgan for a very long time. She's moved on to other things now, but she was referring to gold, but it applies to silver. She said, gold never settles. And what she meant by that was, if you look all the paper transactions, forwards, futures, options, unallocated, agreements, settled with banks, the amount of paper gold, but this would be true of silver also, relative to the physical supply, is probably 100 to 1. So as long as everyone's rolling the contracts over, not demanding delivery, etc., the market works fine. But the minute some segment of the market says, you know what, give me the silver, give me I want physical delivery.
Yeah.
All of a sudden, the commodities exchanges and the warehouses, the custodians are saying, well, wait, we don't have that much silver. They have to go get it. I'm not saying there's been a default, but what I'm saying is, all of a sudden, there's a scramble on the physical side to keep up with the paper side. You can never keep up with the paper side. It's way too big. So then you get into the dynamics of a short squeeze. So that's driving it. But I've said all along, if gold's going where I expect, and I've given a forecast to my readers in my newsletter, Strategic Intelligence, of
Modern conflict is no longer limited to missiles and tanks. Financial warfare has become a central tool. The freezing and attempted repurposing of hundreds of billions of dollars in Russian reserves after 2022 sent a shockwave through global finance. These assets were legally earned, legally purchased, and legally held, until they weren't. For countries holding large U.S. Treasury reserves, the message was unmistakable. Gold carries no counterparty risk. It cannot be frozen with a keystroke. While nations are not dumping treasuries en masse, new reserves are increasingly diversified into gold. Trust, once lost, reshapes behavior permanently.
$5,000 by the end of 26. I called my editor the other day and I said, we have to publish quickly because I'm going to hit that before we publish the forecast. But
I was going to say, are you going to move that forecast now?
Well, I probably will. I mean, candidly, it would not surprise me, not even a little bit, to see $10,000 gold before the end of 2026. I think we will. I like to be conservative in my written forecast because it's good to be right. But $5,000 is within reach. But $10,000 would just come as no surprise for gold. But
because
my point is,
always said, wait, sorry, Jim, I just want to give you kudos here.
Go ahead.
You've always said, since I've known you, once we hit $4,000 gold, you said sky's the limit.
That's right. And there's kind of like a fifth grade math issue here. It's not complicated, but so people think of the dollar price, $100 an ounce for $1,000 an ounce. And let's say you have 50 ounces and gold goes up $1,000 an ounce. Well, you just made $50,000. And if it goes up another $1,000 an ounce, you just made another $50,000. So that's true. But people get anchored on the $1,000 benchmark and making $50,000. But what they forget is that each $1,000 benchmark is easier than the one before because you're working off a higher base and it's a smaller percentage. And just to give a concrete example, when you go from $3,000 to $4,000 an ounce, that's a 33% gain. But when you go from $9,000 to $10,000 an ounce, that's only 11%. That's like a good week the way gold's been going. So my point is, you're like, hey, it took a really long time to get from 3,000 to 4,000, which is true. But so therefore it's going to take forever to get to 10,000. That's not true because it'll make its way to 5 or 6, but it's going to go 7, 8, 9, 10 really quickly.
Gold and silver markets operate on a vast paper system, futures, forwards, options, and unallocated accounts, that dwarfs physical supply, often by ratios exceeding 100 to 1. As long as contracts are rolled over, the system holds. But when participants demand delivery, stress emerges. This is what veteran traders mean when they say gold never settles. Physical metal must be sourced, refined, and shipped, and it cannot match paper claims. Even without a formal default, tightness in physical markets creates scramble dynamics. These conditions are fertile ground for short squeezes, especially in silver, where inventories are far thinner relative to demand.
It's been suppressed for so long. We've had a shortage of supply for the last 6 years or so. Meanwhile, industrial demand has continued to grow and grow and grow. I mean, the shortfall over the last 6 years works out at just a little less than I think it's sort of, I can't remember the figure. But I mean, it's enormous. I think we're looking at 1,200 million ounces. I mean, it is enormous. So I think the first question you have to ask yourself is, how have they managed to suppress the price of silver? And to me, the answer is actually quite simple, and that is that China has been managing the price. But things have changed. And the big change, I think, was at the time when President Trump was elected back in November last year into April, when, do you remember he held up those boards with all the new tariff rates and all the rest of it? China, I think from memory, is something like 50%, whatever. I think that ahead of that, the Chinese could see that the price of silver, demand for silver was running away, and they couldn't really control it anymore. And not only that, but with President Trump threatening sort of huge rate tariffs and really, being very unpredictable in the whole thing. I mean, he would say one thing one day and another thing the next day. It really meant that China had to take a different view on its exports of things like silver, tungsten, and also antimony. I mean, they have great use for this in their own industries. I mean, the photovoltaic cell business has just taken off as the West has sort of embraced the idea that, you've got to do away with fossil fuels. Also electronic use. I mean, if you look at the technology that China now deploys, I mean, it's consumer-based technology mainly, unlike the Americans, which tend to be defense-based technology.
Silver now sits at the center of a global supply shock. China, which historically treated silver as money, has accumulated massive reserves through mining, imports, and refining. But priorities have shifted. Explosive growth in photovoltaics, electronics, and advanced manufacturing has made silver strategically critical. Export controls and tighter licensing are increasingly restricting outbound supply. At the same time, India's industrial expansion, particularly in solar manufacturing, is accelerating at a pace reminiscent of China 2 decades ago. Add to this long-term holders refusing to sell into rising prices, and a perfect storm forms. Silver is no longer cheap, and it may never be again.
They are way ahead of us now. I mean, it's just quite remarkable. I mean, they can literally flood our markets with electrical vehicles, EVs. I mean, and all this, of course, leads to growing demand for silver. So I think the point is that they have decided that they need to protect their own silver stocks, which they will have accumulated a lot. I mean, it's bear in mind that the management of the nation's silver resources is in the hands of the People's Bank, along with gold, because they regard it as precious metal. They regard it as money, if you like. China most recently was on the silver standard. I mean, I'm going back into the 60s. So silver very much is money as far as the Chinese authorities and the people are concerned, as well as gold, of course. And so they need to, they will have accumulated substantial stocks because apart from anything else, not only have they become the world's second largest nation by mine output, but also they've been importing doré from elsewhere and also refining other ores, like sort of copper and nickel and so on and so forth, all of which contain some content of silver. So they will have accumulated a hell of a lot of silver, but they need to protect those stocks now rather than use them to suppress the prices in the interests of their manufacturing industries. And this is the trouble. And it's happened at a time when India is growing. It's growing like China was 20 years ago. The rate of economic development in India is staggering. It really is. I mean, they talk about GDP going up 8%, whatever, but I think that's only part of the story. The point about silver and India is that there is now huge industrial demand in India because the government itself has subsidized and encouraged large businesses to get into the photovoltaic cell production industry. So they've become huge importers of silver. So, and what China is doing, the next phase, if you like, of it trying to protect its silver stocks will be in January, coming January, when they're talking about having a tighter licensing system for exporters. Basically, what this means is that supplies coming out of China are going to be more and more restricted.
Yeah.
It won't stop totally, but they'll be more and more restricted. And yet Indian demand is accelerating. And at the same time, of course, all of us who have been sitting on silver saying, oh, it's far too cheap for, years and years and years, suddenly see the price rising. Do we turn sellers? No, we say, we've got to hold on to it. Yeah. And so you can see that there's a sort of perfect storm, really, as far as silver is concerned.